everyone. A very good evening. You're watching The Money Show on ET Now. I'm Mubina Kapasi. The cabinet meet was just on, so we're a bit delayed, but nevertheless, we are right back. And let's tell you what we have lined up today on the show. The recipe for constructing a good debt portfolio is what we'll be discussing. Which are the categories within the debt fund umbrella, that are poised to perhaps do well given the current interest rate environment, the inflation environment, among many things. And for that, I have with me one of the largest mutual fund houses in India, the CIO of fixed income investments for Nippon India Mutual Fund. That's Amit Tripathi, who's been patiently waiting by. Amit, thanks so much for joining us today on The Money Show. Apologies for the delay. But let's start off first by talking about what we witnessed in debt funds so far. Interesting to know that we've just culled out some returns category wise, from Morningstar, and we note that it's gilt funds that once again has actually shined very well in 2020. Long duration funds as well have done really well. So to start off with, Amit, debt funds, it's a category that usually retail investors tend to stay away from. Perhaps it's got a lot to do with the jargons associated, with debt fund investing. And, you need to have a little bit of understanding of macros as well. So if you could break it down for our viewers, given the current macro environment, how do different categories of, debt funds, do under different macroeconomic circumstances?
Yeah, good evening. Thanks for having me on the show. Ultimately, you have to have a very simple framework of looking at these things, both as an investor as well as a portfolio manager. As an investor, obviously, the first part is the overall allocation bit, which you need to do between various financial assets, predominantly between debt, equity, as well as any other financial asset that you're looking at. Within that, I think the simplest way of doing the allocation is to do it based on your time horizons. See, ultimately, debt is a very simple category if you have a discipline around a time horizon. And let me give you a very simple example to explain this. See, if you are investing money for 5 years and you buy a 5-year bond, over the 5-year period, assuming that the issuer remains investment grade, continues to fulfill its obligations, what you end up getting is your principal back plus interest. The issue arises if you buy the 5-year bond for 3 months, because in the 3-month period, the issuer is not paying you back, but you are exposing yourself to the volatility of changes in interest rates that can happen in the market. So effectively, especially when it comes to retail investors who are looking at allocation, the most important thing and the simplest thing to do is try to marry the time horizon of your investments with the particular product. There are, like you rightly said, not getting into the nomenclature bit of it, but there are various funds which suit various investment horizons, and you stick to that. You raised the point about government bond funds. The fact is that if you actually take out data for the last 15, 20 years also, you will see that over any 3 to 5 year period, government bond funds actually tend to do reasonably well. Most of the times better than what other fixed income avenues are. They are obviously risk-free from a credit risk perspective, but they do come with the added issue about volatility or interest rate volatility, because of which bond prices move up and down, daily NAVs move up and down. If you are patient and you sit for 3 to 5 year horizon, which is what you should have when you're entering into these type of products, you will not get those negative surprises around volatility. You may look at them when you look at your daily NAVs, but looking at daily NAVs itself is not a good idea. So the basic premise here being, have your investment horizons in your mind very clearly when you're looking at products. And there is a suitability which is very easy to decipher in terms of which product is suitable for which investment horizon. I'll come to the macro environment right now. Even before this entire corona episode, we all have realized it anecdotally by looking at economy data, etc., that there are two things that are at core. We are moving into a low nominal growth environment as far as India is concerned. We are also moving into structurally low inflation environment as far as India is concerned. Now, if these two things are true, then what comes out is that the expectation around returns on any debt instrument, because the general level of interest rates in the economy itself is moving down, has to be on the lower side. So if 5 years back a 9% return was an attractive return for an investor to look at when investing into various types of fixed income products, today that would come down to 6 to 7%, and possibly we would be moving down structurally to even lower numbers over a period of time. So one is to manage expectations when you are looking to invest into these products because of the regime of low nominal growth and low inflation. Second, we have had, unfortunately, some amount of issues in the overall credit space as far as India Incorporated is concerned. Some of it has impacted debt funds as well. And we are in this corona environment right now where the level of uncertainty is reasonably high. And this level of uncertainty is high with relation to how different balance sheets are going to do. If you look at any economy, there are typically 3 or 4 balance sheets, out of which the government balance sheet is sovereign. The corporate and individual balance sheets are where we are seeing stresses right now, which essentially means that when you are working in the credit space, the visibility is slightly lower or relatively lower right now than what has been the case for most part of the last 5 to 7 years. So in this kind of environment, it is better to err at least near term on the side of caution, which essentially means that you predominantly put your allocations into high grade assets, which could be government bonds, which could be AAA, AA rated good quality bonds from good quality pedigreed issuers. If as a bargain you are letting go of some additional returns, it's worth the bargain in the current environment of uncertainty. And possibly when the environment changes over the next 6, 9, 12 months, hopefully, it is at that time that you could want to add some amount of exposure to the various parts of the market, including some credit assets. But as of now, the broader message would be stay relatively conservative when it comes to credit risk. Stay relatively conservative when it comes to interest rate risk also.
Okay.
But at the same time, very important for you to marry your investment horizons with the fund you are choosing. As long as your investment horizons are long enough, we don't see a problem even if you are getting into slightly long duration products such as the government bond fund, etc.
Okay, so we are, of course, in the midst of a very uncertain environment. Given that this is an unprecedented health crisis, companies as well say that we are unsure of what the future looks like. It's definitely better than what it was during the lockdown, but obviously way worse than what it was even prior to COVID. And hence, Amit Tripathi is recommending stay conservative, especially when it comes to credit risk funds. It's okay to let go of a little bit of return, but go for high quality grade bonds and debt instruments. Okay, Mr. Tripathi, I want to take forward your point when you mentioned match your time horizon with the investment instrument that you're choosing. So roughly in terms of duration, we have you have long duration, medium duration, then there's also low duration, short duration, ultra short, and liquid. I think that's roughly the order of the duration. Now, in common parlance in personal finance world, they say that 100 minus your age, that's the amount that you should invest in in equity funds, and the balance in debt funds. This is from a long-term perspective, if you want to use this money, say for retirement or whatever your goal is. And as you come closer to your goal, you should start moving your money more towards debt funds. However, like you mentioned, so let's say if my investment horizon is for retirement, at basically it's a long-term time horizon. Do you think that the government bond and the long duration would be the suited products for me? And as I come closer to retirement, do you recommend, or to achieving whatever goal I want, do you recommend that then I move to maybe a medium duration fund or a low duration fund? Is that how essentially it would work?
So like your asset allocation formula, we also have a formula in debt markets, and that formula is very simple, that your time horizon should be in line with the product that you're talking about. And the formula is that if the product, for example, is a 3-year duration, your time horizon should be at least 50 to 75% of the product duration. So if you're talking about a short-term bond fund, which runs a duration of say 2 to 2.5 years, your time horizon should be at least 18 months to 2 years. If you are if you are investing into an income fund or a government bond fund where the duration is 6.5 years, your time horizon should be at least 3 to 4 years. So 50 to 75% ballpark is what I can guide you in this in terms of understanding is what you should be your minimum time horizon when you're looking at a product. Now come to this question about retirement. So if you are looking at a retirement option, there is a new category which has come up, which is a very relevant category, which is the long duration funds. These funds typically have a duration profile which regulatorily needs to be 7 years and above. So effectively what it means is this is addressing an investment requirement of at least 5 years and above, which is what most people would look at. You can go longer. For example, in these funds, you can invest even for 10 years, 15 years, 20 years, but the minimum requirement of time horizon from your side before which you don't plan to remove money should be 5 to 7 years in the long duration funds. In a normal government bond fund, this could be 3 to 5 years. There is another important thing that I need to highlight here. See, one of the biggest challenges, so I can tell you it's not as if retail or HNIs were not investing in duration products earlier. I think something changed post 2013-14. The last time that we saw a big spike in yields where investors for once decided en masse that we don't like the volatility around duration funds and hence we would like to skip it going forward. So that is a very important element that we need to understand and have a discipline around it. Duration funds will come with their share of volatility. There could be a year like last year when duration funds like government bond funds, long duration funds like Nivesh Lakshya in our case, have given returns in a range of 13 to 17%. But obviously that's not a sustainable return. And if you can get a 13 to 17% return in 1 year, it is also possible that you will get a 2 to 3% return in another year. So rather than getting spooked by 6 month or 1 year returns, what you should be very, very disciplined about is if I am coming into a government bond fund with 3 to 5 year horizon, it does not matter what my annual returns are over a period of time. It will give me commensurate returns, which in most of the cases will be better than what I would get in traditional savings products. Similarly, when you're planning for retirement, you come into a product, a long-term, a long duration product. I'm just giving an example here like Nivesh Lakshya. So if you have a time horizon of 7 years, 10 years and beyond, you will not get negative surprises because whatever volatility investors see and get spooked by is interim volatility, which is something that is a characteristic of any long duration fund. And that is something that you should have in mind when you are investing into these products. Barring that, I think these are very, very attractive opportunities for long-term investing, for asset allocation without any worries as far as the investor category is concerned.
Okay. Okay, excellent. I wanted to know your opinion on, liquid funds. Many a times we often say that, instead of putting your money in a savings account, and now all the more because obviously since the RBI as well has been slashing interest rates, the saving account interest figures are really, really, really low. And now, of course, thanks to technology, with just a few clicks of the button, you can transfer money from, your savings accounts to, a liquid fund. So, I mean, do you think that that's something that still works? I mean, that what kind of a role do you see liquid funds play for retail investors? Because again, this is something that's widely used by corporates, etc. For treasury management. Similarly, overnight funds. So, what sort of a role would they play for retail investors?
So there are two key roles that a liquid fund does. One is it helps you manage your excess surpluses or temporary surpluses in a much more efficient manner than typically what a current account or a savings account would do for you. This is obviously I'm referring to in terms of the impact that it will have in terms of how you deploy, at what yield you deploy your surpluses over a period of time. In fact, not recently, but in the past, we used to have a very good PPT which actually talked about compounding or the power of compounding even using liquid funds. Now, imagine this scenario that if as a habit, you are a salaried individual or you are running a business, and as a habit, instead of putting money into savings account or current account, you actually put that money in liquid funds, which are completely withdrawal, can be withdrawn at a day's notice, which are only investing into very, very short term, very, very high grade instruments, hence no credit risk per se, and which yet are offering you a tangible difference in terms of the potential returns that you can generate on a daily basis. These are products where you can come in and go out now, even after the load feature within 7 days. If it's an overnight fund, you can go out and come in every day. The fact is, they give you this difference in interest benefit. They give you huge amount of flexibility in terms of coming in and going out. These are very, very smooth processes, and investors actually don't face any issues whatsoever, whether institutional or corporate or retail. And finally, that unlike or rather like a savings or a current account, you could actually use your liquid fund as the fund where you transfer money, for example, at the beginning of the month, allocate all your expenditures from that savings that you put there, allocate your general expenses, you move into other equity funds, other debt funds, etc. from that, using that as a as a one window where your money is getting efficiently, or rather your money is efficiently earning for you while it is there, and it also gives you flexibility to move in and move out. So I think liquid funds that way, from a flexibility, efficiency, relative return attractiveness perspective, and safety perspective, I would tend to rank them very, very high. And there is a reason why liquid fund category is the largest category in the entire debt mutual fund space for so many years. It is because of these features, which a lot of corporates have used over the years, but many individuals, including HNIs and retail, have also used. And everyone, I have never come across a liquid fund investor who is unhappy, to be very honest, till date.
Okay, excellent. So liquid fund definitely is continues to get a thumbs up. Amit Tripathi, of course, goes out and says that there is no liquid fund investor out there who would be unhappy with the fact that they've invested in a liquid fund. Before I let you go, Amit, I also want to take in your opinion and your views on some of the latest rules that SEBI has introduced with respect to the fact that a mutual fund will have to trade at least 10% of corporate bond deals via exchanges, and then there's also, of course, the fortnightly disclosure of the schemes, the debt fund schemes. I mean, what does this mean for a debt mutual fund holder? If you could just sort of break it down for them, explain it to them what it means.
So, so to put it on record, I think the mutual fund industry is the most transparent financial services industry in India. As an investor, you not only look at, as of today, at my monthly fact sheets, which give you end of the month position of each and every scheme. In fact, as an investor, you can actually go to very easily available data, which actually gives you 100% details of all my transactions done during a month in respective schemes where you would have invested in. Over and above that, there are hundreds of hundreds of publications, research that is undertaken, where you get a lot of information about what mutual fund schemes are doing, where they are investing, where they are generating returns from, what are the risks, potential returns, etc., etc. So I think in terms of level of transparency, let's start with the fact that we are the most transparent financial services industry. And in that respect, I think a lot of it can be credited to the regulator. In this case, the regulator has gone ahead many steps forward over the years to ensure that the level of transparency keeps on increasing and keeps on providing that additional comfort to the investor, because at the end of the day, unlike a banking system savings product or a fixed deposit product, we are a market return linked product, and hence investors need to understand as much as possible in terms of what we actually do and what we actually carry in our portfolios. It is in this light and keeping this transparency in mind that the regulator has further moved from a 30-day disclosure norm to a 15-day disclosure norm, which in a sense only adds to the transparency that is already there in the industry. And I don't think anybody in the industry has any problem doing that whatsoever. And it is at the end of the day going to help investors also in getting more frequent information about what the scheme is investing into, what the portfolio looks like, what are the potential return drivers, what are the potential risks, etc., 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 including quality, duration, etc., etc. As far as the move of mutual funds and hopefully other investor categories into the exchange trading platform is concerned, today, if you look at the debt markets overall, you already have a large part of debt markets already trading online on a platform, which is the CCIL platform, which is for government bonds, both central government bonds, state government bonds, as well as treasury bills. Corporate bonds and money market papers till now have been an over-the-counter market. It is again in the interest of transparency, better price dissemination, and better information availability, so that a larger number of investors can participate, that the regulator has decided to move in this direction. Again, this is something that is completely in line with what the industry has been in discussions on. And as long as this platform serves its purpose of these three things: one, higher investor participation; two, improving transparency; and three, providing more avenues for people to actually look at various levels on various bonds, etc., that are trading in the market on a real-time basis. I think this works well as far as the development of markets are concerned. Right now, as I understand, it is compulsory only for mutual funds, but because mutual funds also are a predominant player, at least in the corporate bond and money market segment, as we incrementally move there, we believe that many other larger market categories and subcategories will also slowly start moving there, because ultimately this platform is more about transparency and access, which is a positive for everyone.
Yeah, that's extremely important because it makes investors as well very comfortable. Then, the more the transparency, I guess, the more comfort as well for retail investors. Okay, Amit Tripathi, really appreciate you taking our time today on the Money Show, guiding our viewers on how they can go about constructing a good debt portfolio, pitching one category under the other versus the other, pardon me. And I guess this was pretty useful as well because, usually retail investors tend to stay away from debt funds. Okay, well, on that note, we will take a very short break. Don't go anywhere.